Before you buy any buy-to-let property, there's a few numbers that you need to check. In this video, I'm going to show you what you need to look out for. Hi, my name is Joe Martin, and over the past 3.5 years, I've been investing in buy-to-let properties in the East Midlands. And over the past 12 months, I've been helping investors like you do exactly the same. So let's dive into the most important number that you need to consider before buying a property. We need to understand what the market value is rather than the purchase price. Vendors and agents will naturally want the highest purchase price for their property, but sometimes that's not realistic when you compare it to the true market value. If you're paying above the market value for your property, for one, your returns are going to be much less than if you bought it for the market value or actually below the market value. And for two, if you wanted to sell the property in the future, it's going to be much harder to get the price that you want to achieve because the market's actually going to have to catch up to the price you paid for it. Remember, you want to buy a deal, not a property that you love. So how do you work out the true market value for a property? So you want to go to Rightmove sold prices and look at the postcode within a 1/4 mile radius within the last 6 months. You want to be checking 3 comparables of the same size of property, the same type and the same condition. Next, the gross rental yield is one of the easiest ways to work out potential returns in the future. You can calculate it by dividing the annual rent by the purchase price, multiply it by 100 and that will give you the gross yield. For example, if you buy a property that's worth £120,000 and it rents for £900 per month, your annual rent will be £10,800 per year. And dividing £10,800 by 120,000 times that by 100, that will give you 9% yield. And in the East Midlands, aiming for a benchmark of around about 8 to 10% gross yield is a really good number to go by. Some people like to use gross yield because they're buying with cash, which is why we use return on investment because this is including the expenses. These expenses include the mortgage interest payments, maintenance, management and any void periods that you might consider, subtracted from your rental income. So say for example, you're buying a £120,000 house, you're actually going to be investing £50,000 into the property. So that includes deposit, stamp duties, legal fees and a renovation, and you're renting the property out for £900 per month. After all expenses, let's say you're netting profit around about £300 per month. That's £3,600 per year. And if you divide £3,600 by £50,000 investment into the property, multiply that by 100, that'll give you a return on investment of around about 7%. And if you're looking for around about 7 to 10% return on investment, that's a good place to start for a buy-to-let investment. And when you look at 7%, you probably think to yourself, I'm better off just putting it in a stocks and shares account. There's less hassle and less stress. So say for example, you're getting 7% return on investment from the rent, you're also going to be getting a capital appreciation, and if we look on average, around about 4% per year. This is a benefit compared to other strategies because you're getting the capital appreciation and the rental income every single month. And with the correct systems in place, this makes property one of the most reliable and safe investments to make. There are 2 variable costs to be aware of, and this is what you need to consider as well. One being the mortgage payments per month, and also the renovation that you'll be paying for each property. You can have a conversation with your mortgage broker and they'll tell you the best way of funding the property. They'll be able to tell you the best interest rate, the best fixed term, and the best loan to value that you're going to need from the bank. Normally, a higher loan to value means less cash up front, but higher interest rates that you're going to be paying per month. The second variable cost I wanted to talk about is if the property needs work, which is why having the right team is so important. They need to realistically quote the job before you actually buy the property with a contingency of around about 10 to 15%. These numbers of the renovation can make or break your investment, so getting your numbers right is absolutely crucial. To sum up this video, always check the purchase price versus market value, gross yield and return on investment, mortgage terms, mortgage rates and refurbishment costs before you buy any buy-to-let property. I offer a fully hands-free service which will make sure you're ticking all the right boxes, but if you're interested to learn a bit more about the service, click the link, leave your details, and I'll be in touch to see if I can help. Thank you very much for watching, and I'll see you in the next video.